Welcome, everybody, to EverydayFI, where we explore the lives of everyday people pursuing financial independence. I'm your host, Meghan Combs, and I'm here to say that you do not need a $1 million book deal or a famous blog to reach FI early. By talking with real humans, I'll show you how to forge your own path to financial freedom the everyday way. Today, I actually have a really huge treat for you all. Normally, I'd be recording a Meg's Money Musings episode, but instead, I'm hosting a live coaching session with David Robinson and Jess. David will be looking over Jess's portfolio live on the show, and we'll talk to her about FIRE readiness. Jess is new to the FIRE movement and finds terminology and principles extremely daunting. Other than living frugally, what more could she be doing? How does the 4% rule work? How can she use calculators correctly if she wants to understand scenarios like cost-fi? Could compounding returns enable her to take a passion job in a couple years? I'll be facilitating this conversation in the background, so the focus is fully on Jess and David. We're going to introduce them shortly, but first, a word from our sponsors. And we're back. Welcome to the show, Jess and David. David, why don't you kick us off with the intros?
Hello. So my name is David, and I am an aspiring financial planner. Anybody in the FIRE community that has talked to me knows that I love the FIRE community itself. I love the idea that you can use money to take control of your life, leave your job if it's not something that fills you up, or if you just hate it. And yeah, I love looking at numbers and helping people discover possibilities. What I often find is that people who are new to the FIRE community know some of the basics, like what the 4% rule is, or that they need 25x their expenses, but they often don't realize that they can have most of the benefits of FIRE without being anywhere close to that. And that's what I really enjoy helping people discover. So I'm super excited to meet Jess and hear more about her story and what she's looking to achieve today. So Jess, go ahead and tell me a little bit about yourself and kind of what you're hoping to walk away with from today's meeting.
Thanks for having me. I spend my days in corporate tech and strategy, but the truth is, I haven't always paid much attention to my personal finances because I was scared of it. So even though I saved a lot, I never really tracked how that saving was going, and I just avoided looking at my numbers for years and honestly wasting a lot of time and money now that's on the table that could have been invested. So recently, after getting into this podcast and some other financial media channels, I've gotten really curious about financial independence and how people make it work. So I'm here today to understand where I am, how I'm doing, what I should do, and figure out my path forward. And maybe that can help listeners who are on the same boat.
Awesome. Well, to kind of start us out, tell us more about how you discovered FIRE and, what you know so far or what your kind of understanding is.
I had a couple podcast recommendations sent to me, and they weren't necessarily about FIRE, but they were from female content creators in the FIRE space, including Meg. I think that some of the podcasts that I was listening to were really good about making financials understandable instead of daunting. And so I started looking at my own portfolio. Also, I used to be on Mint and now I'm on Monarch. And because I have to pay for it, I started paying much more attention, and I really like their Sankey graphs and stuff. And so I think it just naturally happened. And I also own a house, so there's just a lot that I kind of have to keep my eye on now. And as I've gotten further into this content, I've realized how much more I could be doing.
Awesome. So yeah, well, I guess let's start out with like just some of the very basics, right? I think in the FIRE community, we mentioned it a second ago, we often talk about the 4% rule, okay? Or a reverse of that is needing 25 times your annual expenses in order to have enough to retire. So here's where that comes from. it wasn't meant for the fire community, or it wasn't designed for the fire community, rather. Back in the 1990s, financial advisors didn't really know how much money a client needed to have invested to be able to sustain a standard sort of 30-year retirement. And there was just a lot of guesses. And with the stock market going gangbusters in the 80s and 90s, a lot of financial advisors were saying things like, hey, you can take out 8, 9, 10% of your portfolio every year and never run out of money. Because for a couple of decades, the stock market just had this meteoric rise. So only taking 10% of your initial portfolio and bumping that up for inflation every year seemed like it would work just fine. Well, in the early 1990s, there was a guy named Bill Bangham. He was a financial advisor. Now we had computers with Excel or some other spreadsheet software where he was able to really crunch the numbers. And he said, okay, let's look back to about 1926, because that was the data that he had available to him. And let's look at a portfolio. And he ran various portfolios of 50% stocks, 50% bonds, 75% stocks, 75% bonds, etc. And he said, okay, a person retiring in the worst possible time where they encountered a really bad sequence of returns. In other words, they encountered really poor stock market performance in the first decade of their retirement. They could spend 4% of the initial portfolio balance and adjust upwards for inflation. And even if they retired into that bad market, they were very likely to not run out of money at the end of 30 years. So here's what that might look like. To make the math easy, they retired with $1 million. 4% of that is $40,000. And every year, cost of living goes up. So maybe the next year they pull out 42,000, the year after that, 45,000, etc. And here's what can happen with that. Most of the time, the stock market goes up. Just the last 30 years of stock market returns. We normally say that the stock market returns 7 to 10% a year, okay? But that's an annualized average. It hardly ever returns that. You can see that there's a ton of years here where it returns more than 20%, right? Those are great years to be invested, okay? But the problem is that you get time periods like this, 2000, 2001, 2002, 3 years in a row of stock market losses. So just imagine you retire in the year 2000 and your $1 million portfolio goes down to 900,000, and then you withdraw 40,000. And then the next year it loses another 13% on top of that. And then the next year, another 24% on top of that. All of a sudden, your $1 million portfolio is just hemorrhaging money because it's taking losses and you are selling stocks when they're down. So that is why we say that even though the stock market annualized return is 7 to 10% over very long periods of time, you want to limit your withdrawals to 4% so that you can account for those bad periods where stocks are going down and you're still selling. Where the 4% rule did the worst was actually in the late 1960s, because the US entered a period of about 10 or so years of really poor stock market performance. The stock market actually lost money during the 1970s as a whole, and that was coupled with very high inflation. And we're getting a little bit like deep into the weeds here, but it's fun to nerd out. 1968, it wasn't so much that you had an annualized return of something like 4% over the 1970s, which was really poor. It was also the fact that we had double-digit inflation in the United States for that entire decade. So there was like the oil crisis, there was, we shifted off the gold standard. There was all kinds of stuff that really smart economists say caused inflation back then. And so imagine if your 40,000 of spending turned into, $95,000 of spending at the end of the 1970s. You've had a decade of flat stock market performance. Meanwhile, you're taking bigger and bigger chunks out of your portfolio. And that is a time when your portfolio would have probably failed. So anyway, Bill Bangham basically said, okay, what is the amount that somebody would need to limit their withdrawals to so that even if they retired into that really bad sequence, right, a decade of poor performance and inflation, that they would still have money left over at the end of 30 years. And that number was 4%. It's actually a little bit higher, but he rounded down. So in the fire community, we've kind of taken this on and we said, well, okay, if I am taking out 4% of my portfolio, then that means that if I save up 25 times my annual expenses, then I should be able to retire off of that and make that last. Now, of course, people in the fire community have much longer time horizons than 30 years. So it's not really meant for us, but it's kind of a good starting point. Okay. So this is why you always hear about the 4% rule in the fire community. And I'll go a little bit deeper. I just love talking about it. So the 4% rule is both not conservative enough and too conservative for people in the fire community. And I'll tell you what I mean by that. So it's not conservative enough in that we have much longer time horizons than 30 years, right? If you're, say, 30 or 35 years old or even 40 years old, you might have a 5-decade retirement, which is longer than the 4% rule was really studied for. The other more important thing is that people in the fire community tend to not retire at a specific age. Like the normal population says, I'm going to retire at 65 and then start drawing Social Security, regardless of my portfolio. People in the fire community say, hey, once I hit this number, I hit 2 million in assets, which means I can spend 80K a year. That's when I'm going to retire. The problem with that is that tends to be at a time when the stock market is at its highest. And when we talk about the 4% rule not working out, it's something like, it works out 96% of the time. Well, the times when it tends to not work out are times when you're retiring at all-time highs, because the stock market is often overvalued and it's more likely to be about to crash. If you want to really go down the rabbit hole of this, there's a podcast, or not a podcaster, a blogger named Big Earn. His blog is Early Retirement Now, and he's wicked smart with this stuff. He has a whole safe withdrawal rate series. There's like 58 articles in it, if you really want to nerd out. And he argues that the 4% rule is not conservative enough. It should really be 3.2% to account for the fact that we have longer time horizons and we tend to retire when the stock market is at all-time high. So I've just named all the reasons why the 4% rule is not conservative enough. Now I'm going to tell you why it doesn't matter, okay? So the 4% rule doesn't take into account several things. Number one, it assumes that every year your spending is going to go up with inflation, which is just not realistic for everybody. Some expenses get more expensive, some expenses don't really change. It doesn't take into account any kind of future cash flows. For example, if you have a mortgage, eventually that mortgage will probably be paid off, right? That's a big chunk of money that is going to disappear from your budget. It also does not take into account the effect of Social Security. In the future, you're going to get Social Security sometime between age 62 and 70. That has an effect on what you can spend now. It also assumes that you're that person that retires in 1968. You start watching the stock market crashing, you watch your expenses go up, and you don't make any adjustments. You don't make any cuts to your spending. You don't take any kind of part-time work on. You don't defer expenses, like maybe you'll take a vacation this year, but it won't be as expensive. There's a lot of different levers that you can pull. The main one, going back to work if you need to, right? That is an advantage that you, as an early retiree, have over, say, a 65-year-old. 65-year-old, unfortunately, their bodies are slowing down. Age discrimination is real. It's going to be really hard once they leave their workforce, especially if they're a higher income earning person, to jump back in and make that same kind of salary. So I would argue that it's more dangerous for them than it is for a fire person, because it's not that hard to earn money, even if it's 10, 20 grand a year. So anyway, that was a whole lot of information about the 4% rule, where that comes from, and why I think that it doesn't matter as much as we think it does. And the reason that I'm saying all this is because people often get very intimidated. They might say to themselves, okay, I spend about $80,000 a year. 25 times that is $2 million. And that can seem like such an insurmountable amount of money. And that might seem like, okay, that's going to take me, like if I math that out, that's going to take me another 15 years to achieve. That means that I'm stuck in this like really crappy job that I don't like for another 15 years. And what I like to help people see is that there is a lot that you can do in between now and having 25 extra expenses that can basically let you take control of your life, right? There's lots of other work that you can do. You can take sabbaticals. You can work with your employer to, go down to part-time. There's a lot of different levers that we can pull. And that's what I really enjoy working with people on. It's like, okay, how can we get 90% of the benefits of actual financial independence much, much sooner? So, okay, I'm going to shift it back to you because I just did a whole lot of talking. What are your thoughts so far?
No, thank you for that explanation. It really cleared things up. I also really appreciate how you explained the time horizon because I know that the 25 multiple, or maybe even just the 30-year assumption in that. And I was like, if I'm in my mid 30s right now, do I have to make sure I die in my mid 60s? So I appreciate that.
Yeah, no, please don't do that in your 60s.
FI has its cost. Just kidding. The question I had was if the 4% rule is both maybe a little too conservative, but also too risky, and I can see your points in both, do you have a different multiple than 25, or would you just say that it depends?
That's an outstanding question. So there are a couple of answers. I'll start with the easy answer. The easy answer is, and it's what Big Earn has studied, the real like safe withdrawal rate for a 50-year retirement, taking into account, retiring at the peak of the stock market, is closer to something like 3.2%. Okay. So if you reverse that, that's something like 33 times your expenses, which is like, holy shit, that's even more
Yeah.
insurmountable. So, but again, get that out of your brain because it's not relevant, right? If you save up 33x, like you're working way too long, and if it's in a job that doesn't let you up, like you've done it wrong. So let's just disregard that. Okay. And I hate to say it, but there are a ton of people out there who are saving 33x their salary. And the only thing that's going to happen is they're going to die with a metric ton of money and they will have spent less of their life living their best life. So, anyway, put that all out of your mind. You kind of hinted at it. It's very individual, right? So, like, every single person is different. They have different circumstances, they're different ages, they have different goals in life. I've talked to people. I'll give you an example. I talked to somebody, and I won't give a lot of details because, it's their private information, but they were talking about they're trying to get pregnant, right? And they're really excited about being parents. They're actively trying. And what they were talking about is they've done a great job of saving. They have, well, I won't say how much they have because I don't want to give details away. But basically, they had saved up, I would say, about a third of what they needed to get to financial independence. And what they were talking about is they're trying to have a baby and they wanted to get to the point where they could get to a point where one of them was working full time because they both commanded high salaries, and then the other was working part time so they could spend more time with the kids. Well, then we kind of started looking at things, and I said, well, what about this? Like I said, if you guys were financially independent, wouldn't you love to both be at home with the kids? Especially when they're young, right? When they're babies and they're not in school yet and everything like that. And they said, yeah, absolutely. I said, oh, okay. So you've got all of this money saved up. What if once you got pregnant, you both left your job, right? You have plenty of runway. And I know a lot of people are maybe going to disagree with my recommendations here, but they had enough money that they had easily 8 or 9 years of spending, saved up. And what that means is that they can go pause work, start living off of their portfolio now, and be stay-at-home parents. How cool would that be to both be stay-at-home parents, to be able to support each other so that it's not just shifting to predominantly the mom to do all the child rearing. And then when that kid hits 5 or 6 years old, whenever kids go to kindergarten, then you can look at, okay, well, let's look at going back into work. And maybe we can go both part-time. Maybe part-time is enough to pay all of our bills. And the money that's invested for retirement, we can just let that grow. That's called coast-fi. When you have enough in your retirement bucket, that it's just going to grow on its own to be enough to support you in your old age. And when we started looking at that, it's like, holy cow, we don't have to grind it out for the next like several years and kind of like hire babysitters for our baby and everything like that. It's like we can be at home until they go to school, and then they're going to be at school anyway. Then we'll go back to work. Will they die with less money? Probably, but they get that time back with their kids. So that's an example of like, you can have a lot of the benefits of FIRE and not be even close to your 25x or 33x number. So it's very individualized. The other thing to look at is, okay, how is your future going to change? At some point, your mortgage will probably be paid off, and that's going to both give you a source of equity as well as a smaller monthly expense. That has an effect. You'll have Social Security coming down the road. And for a lot of people, especially higher income earners, that benefit can be quite substantial. For some people that I've seen, their Social Security benefit that they will get in their 60s is actually enough to cover all of their core expenses, which is like a huge safety net. That makes a big difference too. And here's the other really important thing. I've just met hundreds and hundreds of people through the FIRE community. generally speaking, the people that are in the fire community are not the type of people who are going to retire at 35 and sit on the beach and drink tequila for the rest of their life, right? They're just not that type of person. They are the type of people that, they're going to continue to earn money. And maybe it's on a part-time basis. Maybe it's doing, some kind of a passion project. Megan, the host of this podcast, is starting this podcast, and I have no idea if she is making money. I hope that she is, but this is like a passion project of her.
No. We're just going to say, no, I am not really
But
making money.
it's the
But
type
that's
of
okay.
thing.
I still love it.
Yeah. But I mean,
Yes.
there's so many things that you can do, you know, and it's fully within your control. I'm starting a business next year. That's a terrifying prospect, and I'm actually going to take a lot out of my retirement accounts and take that risk, but it's totally worth it. So my point is that there is this idea out there that is totally false that, hey, I've got to be secure, I've got to save up 25x my expenses. I can't take any risks until I do that. And that is just nonsense, because if you have any little bit of runway, you can do so many incredible things. I'm going to call out, you know what, I won't call her out by name, but there is a person in the fire community who she's just done amazing things. She is, I would say, coast fine, when that's defined as she's got enough saved in her retirement accounts that with no further additions, she'll have enough in old age to have a decent lifestyle. And she stockpiled a bunch of money, and she has just been traveling the world for the past couple of years. She was working a corporate job. It wasn't a bad job, but it didn't light her up. And she went from making a ton of money to now she's completely taken control of her time. She's working part time as, I don't know what you call it, the person that gives tours of, like, she lives in kind of a historic hometown area and she gives tours. So she's like taking control of her life. She's not anywhere close to fire, and yet she's just having the greatest time in her 30s when she's the youngest and best able to enjoy those things. And I understand I'm like rambling on. I get so excited about this stuff. But anyway, the point that I really want to drive here is like, you know, don't look at things as, okay, well, how much money do I need? How do I save faster? And we will talk about how to save faster and more efficiently, but think of it as like, okay, what does my ideal life look like? What would give me like a lot of happiness? And how can I have that sooner? Maybe even now, right? That's really the question to ask. I don't know if I answered any of your questions, but I don't even remember the questions that you asked before. I just ranted for 20 minutes.
Same. I don't remember what I asked, but you gave me lots of thoughtful nuggets of wisdom and maybe even answered questions that I didn't even know that I had. So thank you for that.
So let's shift gears for a second, and we'll look at your actual numbers and kind of talk about your investments and stuff like that, because I did have some questions. And then we can get into the technical side of like, what are things that you could be doing differently or doing more of? But I do want to get into like questions about, what does your ideal life look like? Is there a different career that you would rather be doing? Do you want to take a sabbatical? Like, and then see if we can kind of like get you closer to that perfect life without waiting until you have 2 million bucks.
I don't know what my life would look like afterwards. I feel like, again, because I'm so new to the fire movement, I just thought that I would be working until my 60s. So I just didn't think I could really dream of an alternative. But at least recently, as I've been thinking about this, unless my life changes in a big way, like I have kids, I think I just want to be a barista for a little bit. And because that was one of my first jobs and I loved it, talk to a bunch of interesting people and maybe focus on some passion projects that may or may not make money. But I've seen some cool things in my community with people just starting up different groups that may like be third places, for instance, get communities closer together, that sort of thing. Or even just causes that I care about, like the environment or animals. So I think I would first do that and then probably get bored and want to make money again. And so I'm not sure if that's part-time work, but yeah, I like the problem solving that I get to do in my job, but there's so much outside of that that makes it extremely draining. And I dread the thought of having to do it for decades more.
The work that you do now, do you think it's like something specific to your employer? Do you think that there's another employer that you would be a better fit for, or do you think it's the actual career itself that's kind of burning you out?
Mm, It's definitely not employer specific. I would say that it's, at least for me, my opinion is that it's the corporate world. And so I've worked for a couple Fortune 500s, and it's all, honestly, I think the part that I don't like is managing the politics of everything. So sometimes I have to think more about what I'm saying and when and how it will come off 20 steps from when I'm saying it instead of just doing the work. And sometimes I wonder with corporate strategy and the things, the types of metrics that we're working against, is that truly helping people? Maybe. I don't know if call my own shots is what I'm after, but be able to know that that is not my only path in life, to have a secure lifestyle.
So you talked a second ago about you were a barista, earlier on in life and you really, really enjoyed it. Tell me more about what you enjoyed about that.
I enjoy how fast paced it is and just interacting with people and maybe being able to brighten their day a little bit, or just know how they're doing, or be able to ask how they're doing. And at least for me as a coffee buyer, I love, like, coffee makes my day so much better when I pay for it for $10. But yeah, I really like just moving around and maybe contributing in those small forms. Again, what I do is corporate tech strategy, so that's probably the polar opposite of something that requires like more manual, like automated work, like a barista job would. Again, I think I like both ends, but sometimes, yeah, managing the politics makes me use my brain way more than I want to. And I think it's in a way where I don't think is actually, positively consequential to anyone.
Okay. I'm hearing you say a lot of different things. One of the things I'm hearing you saying is that you really obviously enjoy interacting with people. And it sounds like you don't get to do that as much. And you'd mentioned that it's very political, the type of job that you're in. And so you have to kind of watch what you say. And yeah. So I don't know. And I'm certainly not like a career coach or anything like that. And frankly, like the way you described your job, I'm like, I still don't really know what any of that is. Sorry, it's just not my world. But it's possible that because when we look at your numbers, like there's a good chance that maybe you're coast-fi, but you're not obviously full-fi yet or anything like that. So you're probably not at the point where you could like never work again. But again, there are other options. Like maybe you leave this corporate job and you take a sabbatical and just kind of recharge, even for like 3 or 6 months. Just go and do some traveling if you want to travel or whatever. There's a lot of different options that we can talk about, right? And then you can kind of like once the dust sort of settles, because right now you're in your own head, you're in work mode and everything like that, and maybe it's hard to envision yourself doing a different career or doing a different job, but maybe some time off would give you a little bit of clarity around that, where you can start thinking about things. And part of that might be like, hey, let's take that barista job, and kind of you're probably going to make, I don't know, 15 bucks an hour or something. It's not going to obviously replace your current salary, but anyway, that might be something you can do for a little while you kind of figure things out. That's perfectly okay. Anyway, I like to look at things as like, let's maximize lifetime happiness, right? So, well, let's shift gears a little bit and we'll get back into this. So, I do want to look over your portfolio and I'll kind of read through the information that you sent me, which is your balances and everything like that. All right, so right now you've got, just doing some mental math here, about just under 500,000 saved up, saved and invested. Does that sound about right?
Hmm.
Okay. And it looks like about 200 of that is in your retirement accounts, and the rest is in a brokerage account, and you have a little bit of cash. Okay. You actually have a few different brokerage accounts here. Can you tell me more about those? Was it just kind of like I wanted to try out Robinhood and Wealthfront, or did you have specific reasons for having these separate accounts?
Somebody close to me set them up for me a while back and just did some automated like maybe $1,000 over the years from every month going into those accounts for the Wealthfront and Vanguard ones. So those ones are newer and or are older. And then for the Robinhood and Schwab accounts, those were set up by me and are definitely more risky investments. So far, it looks like they've been paying off. I don't know how long that will last, right? But yeah, I would say that those were also both set up fairly recently once I started becoming more interested in my finances.
Okay, cool. So yeah, for people listening, I'm going to scroll down a little bit and we've actually got your investments in here. Are you able to read that okay? I guess you have it because you wrote this, but
Yeah.
yeah, so looking at this, I did some rough math and it looks like approximately about 220,000 of this. So about 40% of your total investments here are in either individual stocks or individual ETFs. So you've got like some dividend paying stocks, some, I don't know if you mind me saying like what they are. Okay. Yeah, so I noticed we've got some things like JetQ, which is a basically, I'm not going to describe this very well, but it is meant to pay you a very high dividend, usually 10 or 12% per year. They're writing options and things like that and paying you that high yield. Yeah, so just kind of looking through this, let me ask you a question. Did you have specific reasons for why you bought each one of these, or was it more of like a, hey, I just kind of want to test things out and see what's out there?
Just testing things out. I do have a friend who is a lot more financially savvy and very risky, to be honest. And so I talk with her about, or I'm basically, these are the ones that she recommended if it were her money.
Okay, awesome. Yeah, so here's what I'll say about this. There is an argument to be made for simpler is better, right? And what I mean by that is that there are some people in the fire community that have portfolios that are as simple as everything in VTSAX, which is the total US stock market. It's buying a little fraction of every one of the 4,000 publicly traded US companies. Some people introduce some international in there or even a bond fund. And there's no right or wrong answer. My opinion on like asset allocation and what is quote unquote best is whatever you're actually going to stick to. And what I mean by that is that there's a statistic out there that although the stock market returns 7 to 10% per year on average, the average investor makes about 3%. And here's why that is. It's human nature to look at various different investments and say, well, why would I bother with VTSAX with its paltry 7 to 10% a year when this other mutual fund, or this other ETF or stock returned like 50% in the last 4 years or something like that, right? And we tend to look backwards at performance and say, okay, it did really well during this time period. Therefore, it will keep doing well. Therefore, it will keep outperforming the overall stock market. And unfortunately, that's just not true long term, right? And so I always caution people to, not that this is what you've done, right? Because I don't know, but looking at the past returns of an investment and assuming that it's going to continue to do really well. So technology is the really easy target, right? Technology stocks are a good example of something that has done incredibly well over the past 15 years and has outperformed the overall stock market. And a lot of people take that as a lesson that says, I'm just going to put everything into technology stocks because I want those 15, 16% returns per year. And of course, anybody that lived through the late 90s knows that technology stocks, when you take into account the entire portfolio, or sorry, the entire period, well, they're no better or worse than the overall stock market. They're just more volatile. So anyway, I really caution people against looking at past performance, especially very short past performance, like less than 30 years, and extrapolating that out and assuming it's going to continue, right? The other argument is just for simplicity. Like, this is a lot of stuff to track. I'm looking at like, I don't know, 25 different ticker symbols. And just for mental clarity, if you simplify this a little bit, it would just be really easy to manage. Like if you were just, and I'm not recommending this, right? But if you just wanted to go VTSAX and maybe a little international, that's like two ETFs to track, super duper easy. And frankly, your long-term performance will probably be I mean, it'll be the overall return of the overall stock market is what you'll get. And then the only other thing looking at this, especially because a lot of these are very high dividend stocks. So if you don't already know this, the way that these things are taxed is this. When a dividend is issued, if you've owned that share for, well, let's see how to explain this. I don't know if I want to get too technical, but if you've owned the share of that ETF or that stock for less than effectively 4 months, it's more technical than that, but just imagine 4 months, then it is going to be taxed at the federal level at long-term capital gains tax rates, which based on your income is about 15%. The state that you live in tax on another 4%. So every time you get issued a dividend, especially from these really high dividend players, 20% of that is going to the government. Compare that to an index fund, which does not issue a huge amount of dividends, and they actually have ways of being very tax efficient about it. You're not losing as much to taxes. So if you wanted to, you could kind of simplify your portfolio, just have one or two or maybe three index funds in there. It'd be more tax efficient, much easier to keep track of, and you wouldn't have such a concentrated risk in a lot of these like individual ETFs.
So if, say, Jess wanted to keep the dividend stocks, or if there are some people in our audience who have interest in dividend stocks, would you recommend that they put them in a more tax efficient shelter, like, say, a Roth IRA?
Yeah, so that's a really good question. The first question that I would ask is like, do I have a reason for having these dividend stocks, right? There are some people who are individual stock investors and they have the temperament to hang on for the long term and they do really well. So I'm not saying that nobody should own individual stocks or these very specific ETFs. I do think that most people are better off just being index fund investors. But going back to your question, if you do own these dividend funds, which are taxed a little bit less favorably because they're constantly forcing you to take income and pay taxes, then yeah, holding them inside of a retirement account like your IRA or Roth IRA, that's going to shield them from those taxes that you have to pay. That's a good question. But again, I would just go back to, okay, are these serving a purpose in my portfolio, right? And I'll give you an example. There are people out there who are dividend investors. They would rather take a lower long-term return and a higher dividend yield and let that income flow into their accounts every quarter when the dividends get paid out. I will say that like if you look at the academic research on that, dividends are not free money. Generally speaking, a higher dividend stock is going to have less capital appreciation over time, so less share price appreciation. Whereas like a growth stock, like most of what's in the S&P 500, is going to have a much smaller dividend yield, if it has a dividend yield at all, and much longer, much greater capital growth over time. So just remember, there is no free lunch when it comes to dividends. And I think a lot of people think that dividends are just free money, and they're really not. But personal finance is personal. Some people love having that income come in every quarter or even every month, and they don't like to sell shares, and they just want those dividends coming in and spending that money. So I'm not going to tell you that you're wrong for wanting that. But yeah, so what are your thoughts on that? Are you like very partial to any of these stocks or ETFs that you have, or was it kind of just like, your friend invested in these and you kind of followed her lead?
For some of them, yeah, I think the higher yield ETFs definitely followed suit. A lot of the ones on the Wealthfront account are actually, no, everything is automated. So it wasn't me choosing them, but I do like the idea of simplicity. Like if everything was just in VT Sachs, that would be fine with me. It's less to track for sure.
Okay, and I'm so glad you brought that up because I forgot I had a Wealthfront account like 10 years ago, and I forgot that they ask you a series of questions to determine your risk tolerance and then diversify you a lot within these different ETFs. That totally makes sense. Now it makes sense why you have all of those in your Wealthfront account. So, well, that kind of answers that. But yeah, I would say, if you don't have like a specific reason, then yeah, I would simplify it. Now, the thing that you're going to run into is that you'll have to pay taxes on the gains if you sell these, right? So that might be something that you choose to do not all at once. Depending on how much of a gain you have in these stocks, and I don't know what that is for you, but depending on how much of a gain you have, you might want to hold off or spread it out over several years just to kind of spread the taxes out. Or, if you decide to take a sabbatical, that's a great year to harvest some of these capital gains. Anyway, but yeah, thank you for bringing that up because that
Can I
totally makes sense.
can I clarify that? So when you say sell, you mean if she wants to go down to a VT Saxon chill type of portfolio, don't do it all at once because the tax hit will be big. Is that what you're saying?
Yes, it could be big. And so, because I don't have enough information on here to see, like, there's something called cost basis, and that's what you paid, for that share that you bought. So, to make up an example, if you bought something for $10 and it's risen to $30, your cost basis is 10. When you sell it for 30, you have to pay taxes on that $20 gain. For you, based on your income, your capital gains tax bracket is about 15% for shares that you've owned longer than a year. So what that means is that whatever profit you have, right, your selling price minus your cost basis, whatever that profit is going to get multiplied by 15% on the federal level, and you'll have to pay tax on that. And then in addition to that, your state charges another little over 4%. So it's about 20% that's going to go to taxes, which is why I would just kind of have a plan for how you want to decumulate those. And here's what that could look like if you do decide to take a sabbatical or take time off or whatever, and you need money to live, just start selling these stocks that you're trying to get rid of, right? Just get rid of those. It doesn't have to be like a sell everything, pay a bunch of extra taxes, and then shift into VTSAX. There's more efficient ways to do that. So,
Yeah, that kind of kills two birds with one stone too by just selling the more risky things. Okay.
yeah. Let's see. What else was I looking on in here? So I did notice, okay, it looks like in your Schwab account, there's definitely some higher risk stuff in here. Like I noticed you bought Nvidia. Hopefully you bought it in a really good time when it like before it skyrocketed.
I probably not, to be, I think, oh, so are we talking about NVDY or NVDA?
NVDA, yeah, that's the ticker symbol for Nvidia.
Yeah. Yeah, I think that was definitely after it skyrocketed. To be honest, a lot of my Schwab account is kind of play money, but if there's a reason to be more strategically conservative, then I'm also fine with that.
Yeah, and I'm glad you brought that up. You said, this is kind of your play money account. For a lot of people, they want the lion's share of their investment, right? The biggest portion of it to be in, like index funds, right? But they do still want that play money. And that's okay. What I would say is that I always recommend that people decide on a number, right? I will have up to 10% of my portfolio can be in, I call it dumpster fire money, all of the sort of speculative things, right? Because 10% is enough that, like, man, if you bought Nvidia at a tenth of its current price, like you made a bunch of money. That's great, right? You're going to get all the benefits of that. But if you pick a bunch of stuff that just doesn't end up working out and you lose 90% of its value, which can happen in some of these like very speculative things, well, that doesn't wreck your whole plan. Only, 10% was invested in there. You don't have to use 10%. You could choose whatever you want. But I would just figure out a number and plan for that ahead of time. Like, okay, I'm going to lit my overall portfolio to this number, say 10% into speculative things. And I would put like, if you're into cryptocurrency and that, some of these like JEPQ and JEPI, those are JP Morgan's like options, like high dividend yield ETFs, basically. Not that those are speculative, but yeah, maybe that's a bad example. Those are more for income. Those are going to have lower overall performance than, say VTSAX, because they're not meant to outperform VTSAX. They're just meant to deliver a really high income every month using like options trading. Yeah. So that's something, well, we can dig into that a little bit. This is kind of nerdy. Okay. So have you ever heard of an investor policy statement?
No.
Okay, all right, let's nerd out a little bit. So, well, let's talk about why an investor policy statement is necessary. So, an investor policy statement is a document that you write yourself. A lot of people like to sign their signature on it, especially if they have a spouse, right? It's an agreement that you have with your spouse with yourself and with your spouse if you have one. And it basically is like a summary of how you will handle money, right? How will you handle cash flow? How much will you invest, if you're working? If you're drawing down, how will you do that drawdown? What your asset allocation will be? When you will choose to rebalance? whether that's annually or every 6 months, or when your asset allocation just gets out of whack because one thing grew faster than the other. It's a simple document, and it basically says, okay, let's take the psychology out of it. Right now, while I'm writing this document, and I'm very clear-headed because we're not in the midst of a market crash or anything like that, let's write down how we're going to handle money. And here's why it's so important. Humans are really bad investors. We talked about before, the average investor makes like 3% a year, not 7 to 10%. And it's because we think that we're being rational about things, but we're just emotional creatures. We're really, really smart, but we still have our lizard brains that want to, run from danger when things start to crash. Or likewise, when things are skyrocketing, like, I don't know, Bitcoin is a great example, right? It starts going up, everybody jumps in and they dump a bunch of money into it, and then it crashes. And what does everybody do? They throw it away. And that's human nature to do that. And that is the reason why those people make, 3% a year. So an investor policy statement says, let's take the emotion out of it. Jess, you're watching the stock market start to crash, and this $500,000 that you saved suddenly becomes 250,000 because we have a 2008 style crash. Your lizard brain is going to be telling you, run, 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 run to safety. I can't take any more of a loss. Let me sell the rest of what I have and move into cash or move into bonds. Let's transfer to safety. And of course, inevitably, what's going to happen? You're going to sell everything, and then the stock market is going to start its recovery, and you're going to miss out on all of that. There's countless stories of people who, back in 2008, took a 40% hit, got out of the stock market, and took years to get back in. They got it at an even more expensive point than when they left. It happened again in 2020. Everybody thought, this is the end of the world. This is a pandemic. We're not recovering from this. Nobody would have thought that that would have been a 6-month bear market that recovered so quickly that 2020 actually finished higher than when it started, even with the pandemic sandwiched in the middle.
Okay, can I inject a story really quick?
Yeah.
Sorry. So during the pandemic, I was dating a guy for like a few weeks. He was a total jerk, and he was convinced that it was, I believe, in May. There was like a specific day in May. I think that was like the bottom, and then it started going like, it was like a sharp bottom and then a sharp recovery, which was really weird. And he was convinced that it wasn't the bottom. And he was like, I'm not going to buy in until it's the real bottom. And I'm like, but how are you going to know it's the real bottom? And he was like, well, I have a billionaire friend who knows a lot more about the stock market than you do, so I'm going to take my cues from him. And I was like, okay. And then literally the stock market started recovering like the next day after that conversation. I'm not even kidding. So we stopped talking after that conversation. I was like, you suck. So I just wanted to put that in there. I'm sure he's very regretful of that, or at least I hope so, because I'm petty. Anyway, I just wanted to interject that.
Yeah, and that's a great story. And it's, again, that is our lizard brains taking over and saying, this time is different. The stock market's not going to recover, or I am smart enough that I'll just get back in at the bottom. And it's just impossible to predict that. So anyway, all that to be said, you can Google investor policy statement. You can even use like ChatGPT to like plug in everything that you want it to do. Like, write me an investor policy statement that includes the following parameters. I want to maintain, 75% US, 25% international. I want to rebalance when I'm more than 5% out of whack, or annually, or whatever you want to do. If you're in retirement or on a sabbatical, this is how I will fund my life. I'll withdraw money each month from my brokerage account, or I'll do it once every 6 months. And it's very personalized. It's up to you, right? But you want to do it now when you're very thinking clearly, you're not in the middle of a crisis. And that way, when your lizard brain is taking over during some really terrible event, which you will encounter many crashes during your investing career, you can go back to the investor policy statement and say, okay, we prepared for this, right? Let's just look at what the policy statement says, and then we'll execute that. And this is a living document. This is something that you can absolutely change. Maybe you revisit it once a year and say, okay, well, now that I know a little bit more about this, I actually want to structure my portfolio like this, or I actually want to manage cash flow like this. But you don't do it in the middle of a crisis, right? That's not the time to make those changes. You want to do it when things are calm, you're level-headed and everything like that. Again, you're really just trying to outsmart the lizard part of your brain and fight against the things that are going to sabotage your investment success.
All right, everybody, that was part 1 with Jess and David. Tune in next week for part 2 and the conclusion of Jess's numbers. Thanks for listening to the EverydayFI podcast. If you're loving the show, here are some things you can do. Number 1, subscribe in your favorite podcast player and share the show with your friends and family. You can also find us on YouTube now. Some of the videos actually have our faces. Number 2, please leave a review. I am always looking for ways to improve the show. Number 3, check out my website, everyday-fi.com, where you can listen to all the episodes and leave comments for myself and the guest. Number 4, if you're interested in sharing your own financial independence story and connecting with other community members, you can find a submission form at everyday-fi.com/podcast. And lastly, number 5, join my Patreon membership for only $5 a month at patreon.com/everydayfi podcast. This is a one-woman show, so every little bit of support really helps. See you next time as we continue to go down the path to financial freedom.